Inflation is surging again in August 2025, and the reasons behind this uptick are more complex and controversial than you might expect. If you thought rising prices were just temporary, think again. Let's unpack what's really driving inflation upward and why this might continue for months to come. But here's where it gets controversial. Some of the biggest culprits are tariff policies from the Trump era, which many economists say are still exerting a heavy influence on the cost of everyday goods. According to the latest data from the Bureau of Labor Statistics, the Consumer Price Index, CPI, a critical measure of inflation, rose by 2.9% in August compared to last year. That's a noticeable jump from July's 2.7% and marks the fastest annual inflation pace since January. Mark Zandi, chief economist at Moody's, warns inflation is uncomfortably high and accelerating. He even predicts prices could climb further over the next 6 to 12 months. So what's fueling this inflation acceleration? The CPI tracks how prices change for a variety of consumer items, from everyday essentials like food and electricity to services like haircuts and concert tickets. Recently, inflation is being reignited mainly due to climbing prices in consumer goods. Excluding food and energy, these core goods saw a 1.5% price increase over the year, the fastest since May 2023. That kind of increase hasn't been seen outside of pandemic-related disruptions since 2012. An important, but often overlooked factor behind this goods price jump is the tariffs imposed during the Trump administration. Sarah House, senior economist at Wells Fargo Economics, explains that tariffs on imported goods remain one of the main reasons prices for physical products like clothing, furniture, household appliances, and recreational goods are rising. Imports from Asian countries, key suppliers of apparel, have been hit hard by these duties, which companies eventually shift onto consumers, though often over several months due to the complexities in pricing strategies. Zandi points out, we're seeing some of the largest tariffs since the 1940s, and that's unquestionably contributing to the increase in goods prices, adding a layer of legal drama. Trump's tariff imposition relied heavily on the International Emergency Economic Powers Act, and the Supreme Court is set to examine the legality of this approach in November. Even if Trump's administration loses the case, economists suggest there are alternative ways to maintain many of these tariffs. But tariffs aren't the whole story. Grocery prices also climbed significantly, rising 2.7% in August, compared to last year, their fastest pace since August 2023. For some foods, tariffs may be playing a role. Coffee, imported mainly from countries like Brazil and Vietnam that face high import fees, is one example. Additionally, the supply-demand imbalance causing sticker shock on products like beef is adding to grocery bills. According to a Wells Fargo Agri-Food Institute report, rising costs in fruits, vegetables, meats, poultry, fish, and eggs are among the biggest contributors to food price inflation. BlackRock's chief strategist, Gargi Chaudhary, highlights that many food prices are impacted by tariffs because the U.S. is a net importer of food. When it comes to services, inflation is surprisingly stuck and not easing as some might expect. Price growth for services has stalled rather than declining, meaning it won't offset the inflation pressure from goods anytime soon. Electric bills rose over 6% since last August, largely due to booming demand from data centers requiring vast amounts of electricity. Travel costs also surged. Airline fares jumped nearly 6% from July to August, and hotel prices climbed about 3%. This trend partly reflects cautious consumer behavior earlier in the year, when economic worries and federal job cuts caused many to scale back travel, creating pent-up demand that's now pushing prices higher. Of course, it's not all upward pressure. A cooling labor market is exerting downward pressure on wage growth, weakening workers' ability to demand higher pay. This means companies might be less inclined to hike prices if their labor costs remain manageable. Meanwhile, the Federal Reserve is expected to reduce interest rates soon in an effort to boost a shaky job market. But this approach is a double-edged sword. While it may support employment, it risks allowing inflation to become more entrenched. Zandi summarizes the dilemma bluntly. they have no good choices here. The best option is to cut rates to keep the economy from collapsing, but it risks embedding inflation deeper. So what's your take? Are tariffs still an overlooked driver of inflation? Should the Federal Reserve prioritize fighting inflation over supporting jobs, or vice versa? With inflation showing signs of sticking around longer than many expected, these questions will become even more crucial. Feel free to share your thoughts. Do these policies make sense, or is there a better way forward? Let's discuss.